The biggest challenge in the US is the federal state system of regulation when it comes to financial services. Of the G20 nations, there's only one single country in the world of the G20 that doesn't have a fintech charter today, and that is the United States. Why? Because largely the lobbying system in the United States has protected incumbents from having to compete directly with the digital chartered banks.
Dear friends, ladies and gentlemen, I have an exciting guest today, my friend Brad King, whom I first met, I think, around 12 years ago, and I was excited about his vision. I was back then CTO in the large bank, and Brad has shaped my understanding of fintech better than anyone else, I must say. So back then, it was very visionary what the app could bring. And I was inspired so much that we built one of the largest digital footprint in the world back in 2015. We reached over, I think, 45 million monthly active users with Brad's help in the bank I worked for. And that was a bigger footprint than Bank of America, Chase, and Wells Fargo combined. So Brad is, as I said, my friend, a very well-known person, globally recognized futurist, bestselling author, and very renowned speaker. He is also founder of the first first in-app mobile bank called Moven, and author of many bestsellers like Breaking Banks and The Futurists. Podcasts, Breaking Banks and Futurists, and also a famously known author of Bank 4.0, Augmented, and many other books. Hi, Brad.
Victor, it's a pleasure to be hanging out with you again. We've known each other for quite a while now, so we've been in the trenches together. It's nice to be on your podcast. It is nice to be on the other side for a change, because I'm normally the one hosting and asking questions.
Absolutely, yeah. So time for you to speak and me to listen. So let's start with a little bit of a background. You are rightly being called godfather of fintech. And just my question is, what first drew your attention to fintech, and how did you get to this intersection of technology and finance?
It's an interesting question because, when I started in the space, it wasn't yet called fintech, right? Like fintech as a term sort of became popularized around 2012, 2013, probably around the time we met, right? But up until then, it was, we were talking about internet banking and self-service banking and things like that as sort of a categorization. We didn't even call it digital back then, because, this was sort of pre-mobile in many respects. If you think about it, the iPhone came out in 2007, but most banks didn't have an app until like 2010 or 2012, like in that sort of time frame. So it was still very new. But I had seen the .com boom and sort of missed that because I wasn't really in e-com or those sort of things. But I had been working on digital strategy for major financial services brands on the internet, all throughout the 2000s. HSBC, Standard Chartered, Citibank, Amex, players like that, and realized that they were just not ready for what was coming on mobile. And so I wrote a book, which you'll remember, Bank 2.0, it launched in 2010. And it was really showing about how digital was going to change customer behavior away from the branch. And that actually started as a report I did for HSBC's leadership back in 2005, 2006, on what HSBC might look like in 2020. And I saw firsthand the resistance internally within banks for sort of digital transformation. So I realized there was an opportunity there for me personally to sort of become an advocate or catalyst for that change. And while I was on my book tour in the United States promoting my book, I'd been thinking about the idea for Moven, and I had met with some others working on similar ideas. I met with Josh and Shamir, who were the founders of Bank Simple. Josh Reich and Shamir Karkul, and sort of brainstorm some ideas with them. But I realized I wanted to do something really focused on mobile. And so while I was on the book tour for this, I got the idea to start Moven, registered the domain, and got started. But the thing was that when internet came along and started to impact e-commerce and so forth, many in the banking sector thought they had missed that bullet, because internet didn't change our business. Branches are still key, and so mobile's not gonna do anything different. But I saw something fundamentally different with mobile. Is I saw the potential for the wallet and behavior around payments and money, general money management could be completely transformed by mobile, because it reduced complexity. It gave you the ability to do stuff in real time, which you just couldn't do either with the traditional branch-based banking or even with internet banking as it was back then. So I saw that, I felt that fintech was going to completely transform the way we thought about banking, and sort of tried to figure out a way to fit into that schema.
So maybe we can just go straight ahead to misconceptions. So you were really caught by this kind of misconception of large banks, incumbents, who really didn't think that mobile will change their behavior and their customers' behavior. And what do you think are the misconceptions now? So if talking about large financial institutions, what are they missing now? Or what kind of trends you think they are not understanding well enough?
So let me give you an illustration. I'm just about to launch a new book called Branch Tomorrow, which is sort of a follow-up from a book I did in 2012 called Branch Today, Gone Tomorrow, right? But in the old days when we used to talk about banking, branch was considered the primary channel of banking, for establishing relationships, for conversion, for engagement of customers and so forth. And there was a lot of resistance to the idea that could change. Now clearly, if I was to ask most bankers today, based on, that, they would already see that digital has fundamentally changed the way banking has worked. But here's the issue. Most bankers have missed systemically what fintech has done to the banking environment globally. So, let me give you a couple of stats from the new book. If I was to ask most people in the banking sector today, who are the fastest growing banks? Most people would say, all right, digital banks are obviously growing faster today. But if I was to ask who has more banks, or who has more customers rather, the top 20 retail banks in the world or the top 20 fintechs, most bankers would say, banks for sure. And the reality is it's not even close. Fintech's way ahead. So if you take the top 20 retail fintechs, they have combined about 4 billion customers today. The top 20 retail banks have about 2.6, 2.7 billion customers. There's some variability in the numbers, with the way they're measured.
And what about the revenue? What about the revenue in market share? I believe that top 20 banks, whatever, are probably 100x bigger in terms of their financial footprint than top 20 fintechs.
This is where it's interesting, because 10 years ago, when you and I were working together, very, very often and frequently together, the big arguments against big banks versus fintechs were, 10 years ago, the neobanks are not profitable. We don't know if they're ever going to make money. They're never going to be able to manage risk as good as the traditional players. And the only reason they're growing so fast today is because they're small. So let's look at it today. Revolut is on track to be the largest bank in Europe, largest retail bank in Europe. Nubank is now the largest retail bank outside of Asia with 120 million customers, certainly the largest bank in Latin America. We can't argue that they're only growing because they're small anymore, because they've grown to be the largest in their markets. N26 is the second largest bank in the German market. We see this. WeBank is the third largest bank in China. We see this pattern emerging in the retail space, and we see it also in wallets. Having taken a significant market share, particularly in the unbanked segments and so forth. So size, well, already we can see they're still growing and they're the largest. So those criticisms in the past don't work. Secondly, they're never going to be profitable. Well, we know now Nubank is extremely profitable. WeBank is probably the most cash operationally efficient bank in the world, based out of Shenzhen in China. And Revolut is profitable and on their way to bigger margins. Starling's profitable, etc. So that argument's gone. What about risk? But we see they manage risk better, right?
Yeah, and then just talking about the market share, I mean, their market share is still very small, right? If you think of like a market share,
if you think about assets,
payments, or
sure.
Revolut in any country, given country, and they're like in 30 countries globally now. I mean, in each country, their market share is still like below like 4%, I think. So, do you think it's going to change at some point? I mean, that fintech will be seen as like not only the innovation driver and the growth driver, but also like a major player in the field. That they will just take over the market share from large banks. There's large banks still, like in the US, for example. Even in the UK, they like do not feel like depression, right?
Yeah, US is a tough market because the regulation is not helping. Chime is obviously IPO'd and done quite well, and you've got alt-fi players like Circle and others coming in there now. But let's take Latin America as an example, or China as an example, right? Because the US is not a leading market. It's not a leading market in banking technology. It's not a leading market in fintech. It's not a leading market in wallet architecture. The US is many years behind markets like China, for example, in the application of this technology, both at the back end operationally and at the front end in terms of experience. And that's because the way the market's structured in the US. But let's take LATAM. So if you listen to Itaú's earning calls today, Itaú is the second largest bank in Latin America, about 56 million customers, half the size of Nubank. Their entire earning calls now are about how they're going to respond to Nubank. So, that's a good example of a market where the incumbents are already having to answer, to the structural changes that have occurred because of the success of Nubank. But, I look at it in a very simple way, Victor, and you'll appreciate this more than anyone probably because of your, rich technology experience, is that if you look at what comes next with agentic AI and the technology-based application, of financial services, the reality is that you don't go to a bank for their platform or product or services anymore, because now it's all about the fact that you can get that where you are, on your phone, and with AI, it's going to be amped up to the next level. Really tailored to your personal needs, responsive in real time, very contextual. And that requires technical and cultural agility that most traditional incumbent banks don't have. But the Nubanks and the Revoluts of the world, they have brand new tech stacks. They have much more technically agile. They're much more experimental in terms of their approach. So they're much more likely, in my view, to adapt to the AI era than incumbent banks are. Even though incumbent banks may have more assets, the reality is I don't think asset size is going to help you become an AI relevant bank in the future. In fact, it may slow down your adaptability because you want to protect those assets because they're at risk from this. So I really think that the fintech banks and the neobanks that we've seen evolve and have some success in markets is just the first step. The next step with AI integration requires sort of that technical agility and high technical utility trust that is sort of, I think, replacing what we used to think of brand trust in financial services historically. So I think it's going to get much worse for incumbent banks moving forward. There are some incumbents that will succeed. I think players like the top Chinese banks, ICBC. I certainly think JP Morgan Chase has a good shot at this. But banks like HSBC, Deutsche, Wells. That's not so clear that they have a path through this sort of technology disruption to survive. It's much more likely that technologically agile players will be able to come in and take market share from them. And then you've got the credit markets, which is sort of the second piece. So your day-to-day financial services is the beachhead for these technology players. Then credit access, and then finally, I think it's asset size, which goes. But I think AI is going to be a driver for a lot of that change.
Mm-hmm. Do you think though it's going to be like all new players, because now like the world is divided, at least the like B2B world is divided into
Sure.
AI native or GI native companies which were established after GI revolution happened, like 2022 onwards, that have like enormous multiples, like 100, 200x revenue, whatever, growing like crazy at least in terms of valuations, and all others that were like established before the like Gen AI era, right? And you see like the border, which is like 2022 or so. Do you think there will be a new wave of fintechs, like completely new companies that will open doors for like AI revolution, or companies like Revolut, you mentioned, and Stripe and other like this fintech kind of companies will catch up? So I would compare, say, I mean, Google and Meta of this world, right? I mean, they have they try to really catch up on AI revolution, but they hardly can compete with companies like Anthropic and OpenAI. So, do you think that there is something similar going to happen in fintech? There will be like new wave of like vertically integrated AI native companies that will take over, or this fintechs, which you all believe are great companies growing fast, like Nubank, like Revolut, Chime, will like be are going to be like this AI leaders, right? Who will show the way to others. What's your prediction?
It's not clear, Victor. I'll tell you why. But I will say that I do think the fintechs have a better shot at it. But if you think about the biggest change, and we've been talking about this for a long time, is that the way banking will be integrated into your world in the world of AI is, I think, fundamentally different from the way we've thought about banking integration, over the last 500 years. In that, the way we've thought about banking services in the past is you go to a bank, the bank has a banking license, so it can protect your assets. There's guarantees, deposit guarantees, and things like that. And there's regulatory infrastructure in place for that. But you go to get access to, a value store, the ability to move money, and the ability to access credit. That's the core utility that banks have provided. That utility is becoming separated from what we would think of as banking infrastructure. So that utility has become a lot less friction-based and now is much more accessible through the tech layer. But AI will fundamentally change that to be much more personal, in that your personal AI...
And probably like emotional, right?
Yeah. We're a few years away from this, but not that long, where you have a personal AI that you've trained that's integrated into your stack, into your personal technology, whether that's in your car or in your home with a smart speaker or in your smart glasses or you're in your next-gen smartphone, that your AI will hang that together, and it integrated into your personal AI will be the agentic layer, which allows you to do banking stuff.
Right.
And
Right.
so I do think that there is a back-end B2B component of that, or a wholesale component, where you'll have new players emerge that have, agentic AI built financial services layers that can respond in that time. But I do think this is where players like OpenAI and Anthropic, because of the personal AI angle, may, sort of go over into financial services accessibility, at least at the front end. I think that if you don't have partnerships with the operating system players where the personal AI will sit, I think it's going to be much tougher, because let's face it, the app world, as the way we think of it today, won't exist in 10 or 15 years, right? We may still have some apps, but both through the use of AI and tech like augmented reality, is that the way content is served up to us is just going to be a lot more contextual. So defensibility of a brand or an app or, a distribution strategy or an engagement strategy is much harder in that space where your agent is making the decisions for you, right?
Absolutely. Yeah.
So this is the key. This is the key problem, right?
Yeah, I do agree. I would imagine the case that you have an agent and let's call it Victor. So you have an agent Victor in your smartphone, or even not a smartphone, in your whatever augmented
in your
reality,
personal cloud, right? Yeah.
Personal something, and then you just ask for a payment, a credit line, or anything, right? And then this agent is not gonna hesitate to go and scan thousands of different value propositions, right? So brand is not gonna work anymore, because you would not convince agents that this is like a
credit card.
Brand. It doesn't care,
credit card reward programs or airline miles. That won't work for an agent.
It will compare rationally. So all this irrationality goes away, right? I mean, we will not choose just because our friend said that's a good thing, right?
Absolutely.
I mean, agent will compare apples to apples, will conduct thousands of discussions, negotiations, will go into every terms and conditions that consumers never go into. And then we'll find out the best way for you to pay, or the best way for you to transact, or have credit lines, or put your deposits or investments. So inevitably, banks, this relationship become an infrastructure play, right? So they become like electricity or telecom. So you don't care. You don't care, right? So and it means that banks' value will diminish, right? And what banks are creating now, at least the best banks I see, the best example I can think of is Kaspi Bank from this. Do you know Kaspi Bank, right? That's the bank in Central Asia. They now bought the second largest marketplace in Turkey. So this is primarily like Amazon. So you actually have banking under deeply hidden under the marketplace. So they provide you online delivery, whatever, groceries, food, whatever. And then bank is served as a platform to pay all this stuff, right? So they started with that. So this Russian analog of that is Ozon, which is kind of a copycat of Amazon. They started very successful with their fintech platform now, because this is the largest marketplace in Russia. So they are catching up on fintech so quickly, beating all these other players. Another good example is Tinkoff out of Russia, and Russia is the very largest and pioneering all this fintech stuff, which is this Tinkoff Bank is built by. I'm sure Tinkoff. You know the guy.
But I know.
My friend Alex.
How is he doing? By the way,
I'm sure he's doing well. He recovered, and I think that he lives in London.
Thank God.
He's doing well. Yeah.
Oh, good. Well, I'll have to get him back on my show too.
Yeah, absolutely. He's an awesome man. So, here they're building up, for example, travel. So you can order any tickets you want, any hotels you want throughout the world through the app, right? You do not need to care, go Booking.com or Expedia or anything. for your travel needs. So, and on the contrary, as I said, banks will be disintermediated, right, from where they are. So they will not hold customer relationship anymore because there will be some agent that will do it, most probably. So my question is still whether there is a possibility for $1 trillion fintech company. So if you see any opportunity for that, and
but I tell you what it probably looks like, Victor, is it probably doesn't look like what we think of as a bank. It is probably, as you know from my last book on banking, Bank 4.0, I predicted this would be Ant Financial or Ant Global, right? Would be the first $1 trillion financial services company, because I think a wallet paired with personal AI and generative finance is a much better instrument for managing your personal, financial footprint than a traditional bank account. And I think that's where the interface will be. So when you think about operating systems based, whether it's the smart glasses and you're talking to your assistant or whatever, you need a wallet. And I think our wallets are going to evolve into something much more radical than we think of today as sort of a value store. I think our wallets are also going to be where we store our personal data as well as our personal assets, right? So think about longevity treatments, for example. Is your health data, your DNA, your personal biometrics, your longevity score. That's probably going to be in your wallet. Your investments are going to be tied to that wallet. Your different value stores that you have are going to be tied to your wallet. Plus whatever personal preferences you have in terms of travel and things like that, that where your personal AI will interrogate, or build your own LLM, if you like, your own model of behavior, so that it can optimize its responses to that. So I see that sort of wallet, and it's more a data wallet than it is a monetary wallet as we think of it today, as being at the heart of our individual assets and our individual behavior from a responsiveness set. So wallet operators that are multi-currency, multi-market, with these different platform capabilities could be in that sort of $1 trillion category of play, and could be acquired and integrated into personal AI type platforms as well as they emerge. This is one of the reasons which banks are going to have such a hard time with this, because for banks to be able to play in that space, you'd need large consensus building where banks agree on wallet standards and cooperate together. Think of it being like the next generation version of a Visa or Mastercard, where you have banks sort of sponsoring this together globally to create a sort of global standard for agentic operation on the finance side. I don't see banks making any efforts at that. There are no generative finance LLM projects that, in the US, for example, where banks are cooperating together. You have Hyperplane, which was acquired by Nubank, and they have 120 million customers, so they've probably got enough data to build their own generative finance stuff. Ant has enough data to do that. WeBank has enough data. Revolut's getting to that point where they would have enough data. But how many banks have access to 100 million customer records with the financial transaction behavioral stuff to really build that sort of generative finance models? The same is true for healthcare data if we're looking at behavioral modification to improve longevity, right? You need massive data, and the banks don't play well together in that respect. So that's really their core limitation for the AI era, right?
I think that, banks are extremely bad in just building up knowledge and signals out of their own data. I mean, certainly I see it through a bunch of envelopes I'm getting every week from a bunch of the US banks. I mean, the way they present me something, but actually knowing, because I'm customer of those banks, knowing what my transactional activities are, and knowing me so well, I always think why they're sending this kind of offers to me, knowing that I will never accept these offers. I mean, it looks like all these multiple departments there do not really like talk to each other. They have like marketing team, they're just doing one thing, like sales team, and then operations team, then a credit team. And all these people are not like connected into one single data lake. And these decisions are not derived from data and intelligence. It's like really, I mean, compared to Amazon, I think it's like
it's not even close,
100
right?
years, maybe not 100, but 20 years behind.
Let me give you one example, Victor, specifically, right? Take the US market. So, we know credit access continues to be a problem for, lower to middle income households in the US. But, it's really driven off the credit scoring mechanism. But we actually know credit scores are a very poor predictor of default rates, right? Credit scores are more designed to punish you if you default. So you can't get access to credit in the future if you default. So, as a data model, if you're in the lending business and you want to reduce risk, credit scores aren't particularly helpful. They're a broad indicator of your, credit history. But, you look at players like, my bank, and Alipay in the US today, in China, which has 40% of the small business lending market in China now. They're lending to like 55, 60 million small businesses every year. And they can do that. They call it 310, right? 3 minutes to apply, 1 second approval, 0 humans involved, right? And they have half of the NPL ratios that ICBC and, Agricultural Bank and Construction Bank in China have for their SME portfolios. So you have to ask the question, why is it that a wallet player is so much better at managing risk for lending? And it's because they see the behavioral wallet activities on a platform basis of, Alibaba merchants and these people using, the platforms day to day. They've got the data, and so a lot of what you're talking about is a data problem. Is my ability to personalize banking access for you, to give you the best solution to your problem, requires data sets that in many cases banks just simply don't have. If I'm going to lend to you as a bank, as a small business, for example, the first thing I do is ask for 3 years of your financial results, your financial papers and reports. But, a player like Alipay doesn't have to do that or Amazon, because they have that data as a platform. Shopify, for example, would be a really great platform to do lending on because they can see that cash flow data. So I think that's part of the key problem in banks not being able to, personalize for you accurately, is the data's siloed. It's not particularly constructed around you as a psychographic profile. All they can see is in the past what products you bought, and then they can double down on whether you want to buy that product again at a cheaper rate or something like that. And it's in this day and age, we just expect much better personalization that the banks just can't deliver today.
True. So let's switch gears now and speak a little bit about payments overall. So payment volumes are obviously growing, both like consumer payments, B2B, B2C, cross-border. So do you see any breakthrough disruptions in this field? How would you assess like blockchain opportunity in this field? Overall, do you think like Visa and Mastercard are endangered by anything going forward? I saw the recent market shares have declined like 5% or more because of some blockchain evolution and adoption of this stablecoins in the US.
Yep.
So what's your view how the world of payments will shape over the course of next 5-7 years?
Well, let's be really clear. I mean, I think what we would have traditionally called smart contracts in the DeFi space, which, for translatability to the traditional sector. I just call digital contracts, right, today. But smart contracts are the single biggest opportunity in banking, for the next 30 years, right? Let's be clear, because AI will not use core banking systems and it won't use fiat currency to do transactions. So, you have to tokenize, you have to use digital currency, whether it's a stable coin or whether it's a CBDC. I do think that if you take at a global sort of geopolitical scale, trading blocks, so like the EU or BRICS, I do think that CBDCs are going to have an advantage over stable coins because they'll be able to be tailored to specific trade policies and trading agreements that are in place. So CBDCs will be able to reinforce that. Stable coins are not designed to be customized, at that level. But they, of course, are good proxies for, or good digital currencies to use for cross-border trade and in-market smart contract development. But let's be clear, this capability, if you talk about it as financial services infrastructure, is generally net new capability. The DeFi world has been playing with this. Stripe, with their recent announcement of their stablecoin account and so forth, Stripe is going to be one of the biggest players in stable, coin platform, globally, certainly in the West. And if I was Visa or Mastercard, I'd be very concerned about that. I'd be even more concerned if I was Swift, with the development of stable coins. So the reality is that the biggest single opportunity in, cross-border, and sort of large-scale banking, payments is stablecoin and smart contract development. And the 99% of banks have not even done their first smart contract yet. So this is a major threat to the banking sector. And again, you don't have to have a banking competency to be able to deliver these platforms. You need technology competency. And, the DeFi space has been very instructive in helping us sort of understand the potential for tokenization stable coins. But the reality is that DeFi is becoming TradFi when it comes to stable coins now anyway, right? So then you're going to have to play with new networks that work for agents and work on stable coins. So this is why players like Stripe and other players building this infrastructure are essentially going to become the next Swifts and the Visas and Mastercards of the world building that infrastructure.
Do you think that Visa and Mastercard will catch up on this, or you think there will be like new alliances, like all new? In this field?
I mean, if they were I'm working significantly with Mastercard globally on this strategy right now, and I think the Mastercard and Visa both have some elements of trust in that they've got broadly accepted networks, so they could pivot, but they have to pivot to become either sort of wallets that are agnostic in terms of the type of rail. So they basically become super aggregators of wallet services, or they have to become sort of data aggregators, I think, for them to really leverage off their networks moving forward. So they could put in tokenization and stable coins and things like that. The real problem for Visa and Mastercard is that it does fundamentally change their business model, that the interchange model, the more they get into the stable coins and smart contracts and sort of super aggregation, the less interchange is a part of their business. So it does require some pretty flexible thinking. But I do think that they certainly have some network effect potential there that could be leveraged and they could transition. But I want to see them coming up with new service models that move away from the interchange dependence, because that's what will probably kill them if they can't move off of that revenue model.
Yeah, I agree. So what's your prediction on smart contracts, level of adoption, say in 5 years, like 2030? Will we have like at least 10% of all contracts being like globally being smart contracts based, or it's like too aggressive?
Look, I think this is going to be a market by market proposition. I do think China is going to set the pace here. I think when in 2030, when we look at the economies who are have most adapted to smart contracts and are actually implementing autonomous trade at scale, I think there are 3 marketplaces which are very clear, will be clear leaders in 2030. I think that will be China, Saudi Arabia, and the United Arab Emirates. Right? Which, if you think about it, that's sort of very different from the way we think about leading financial markets today. So when it comes to autonomous business implemented on a financial services sector basis, I think those 3 economies have some advantages today and are likely to have some leadership.
Just because of the adoption of regulation as well, right? They're moving fast and they're regulatory.
I think it's cultural agility. I think it's the fact that they're all excited about the future. They all see the future. They all see these changes as opportunities for their economies to differentiate, rather than it being a threat to incumbent sectors and incumbent industries. So, at an economy-wide level, like let's take Saudi. Saudi, implemented a few years ago Vision 2030. MBS himself sort of pioneered that and supported that, and that has changed culturally the way Saudi thinks about their future now. They're positive. They're upbeat about the future. They see that the future is going to get better. You go in the US today, or in the UK, for example, and people think that things are going to get worse in the future, and there is an attempt to sort of want to go back to what life was like in the 1960s, right? So they're moving away from, sort of future-proofing themselves and being more conservative about, these changes that could impact society. So, future readiness really comes down to that cultural acceptance of AI and all of these things that are coming in. How is it going to make life better for the average person? And in markets like China, you have some analogies in places like Singapore and elsewhere where, maybe even Switzerland to some extent. But the 3 markets with the most excitement about what potential the future holds, I would say, is China, Saudi, and the UAE. So, okay. From a financial services infrastructure perspective, I would see them doing 10 or 20%, maybe even in China, 30% of their business at autonomous scale. And I'll tell you, this is why when you're looking at which markets are going to be best at this, where we find indication of this is where do we already see large-scale robotic implementation? Where do we see autonomous infrastructure in place today? So China has dark factories. US doesn't have a single dark factory today. China has 80% of its ports are fully automated, right? So there's not a human on the, on the dock.
South Korea is also.
Yep, South Korea. I agree with that. Yeah, I agree with South Korea and Japan to some extent as well, because they're very pro robotics and they need robotic implementation. So they're also good examples. I'll give you that. But let's take China. 80% of its ports adopted, with automation. They're now rolling out that technology in ports that they're investing in Africa and so forth for the Belt and Road. The US, in the final, months of the Biden administration, there was a massive dock workers strike in the United States. And to close that strike, they had to agree to 20 years of no automation in US ports.
Oh my God.
So you can't have, the US cannot be competitive from a supply chain perspective with those constraints on the system. And the same is true of the financial services industry. If you're not doing stable coins and smart contracts at scale, you're not going to be able to do true agentic autonomous financial operations.
I was always thinking about the US market versus like the UK market. So UK market was opening up, I think 2005, 2010, right? When they implemented this famous known fintech charter and started like opening up markets for new banks and new licenses. established like new policy for licensing the financial services, and there were a bunch of really great companies like Revolut, Monzo,
Monzo,
and
Starling.
many others like
Yep.
Sterling and others, right? That were, I mean, some of them survived, some of them not. Some of them really became great, but it just opened up like a huge disruption and also value creation. I can only imagine what the US market could be if it goes the same path as the UK market, right? Because like the market is like 50, 100 times bigger, right, than the UK market. So what do you think, what prevents like the US market overall from, and policymakers from making this move? And do you like anticipate that it will like be normalized and more adapted towards this
Sure.
innovation in the financial industry, like in Trump's administration and beyond? You think that it's going to open up, or this is going to be like this story about the sport strike and prohibiting innovation for another 20 years? What do you think is going to be the end of the story? Because the resistance is also high, right?
Yeah. I mean, look, as you know, I've worked very closely, not with the current administration, but with previous administrations on regulatory policy. I advised the Fed, Atlanta, Chicago, New York Fed. I advised the Office of the Comptroller of the Currency, OCC. And I was on the board of, fintech policymakers such as the Financial Health Network, where we looked at financial inclusion. So I've got a pretty good idea of the regulatory constraints in the United States. The biggest challenge in the US is the federal state system of regulation when it comes to financial services. If you wanted to have an industry-wide set of, let's say you wanted to create an AI relative, you wanted to create the next generation of fintech licensing, but AI-based capable, AI banks, for example. You want to create a digital banking license for AI banks. Well, that would require you to get agreement with at least 70 regulators in the United States in respect to that policy. And some of the state regulators are going to break from that and want to do things differently. So creating sort of national regulation is very difficult there. Let's be clear. Of the G20 nations, there's only one single country in the world of the G20 that doesn't have a fintech charter today, and that is the United States. Why? Because largely the lobbying system in the United States has protected incumbents from having to compete directly with digital chartered banks, right? And that's, we were very close in 2014 with the OCC to getting a fintech charter in place, and we put out the regulation there and so forth. And the New York Federal Reserve and the New York FDS, they sued the OCC to stop the fintech charter moving forward because they said it wasn't a level playing field with traditional players. So are you going to get that sort of leadership in the United States? So technology leadership, like what we see in Silicon Valley, and the ability to innovate, when it comes to financial services or healthcare, I think is going to be held back by the lobbying group's approach to policy setting in the United States, which is why I think China will overtake the US as the world's largest and most advanced economy in the 2030s. I think largely because of those constraints in terms of the way lobbying groups work, in terms of slowing down competition to the incumbent oligopolies, right? So that's I think it's unlikely that the US is going to have some of the biggest AI-based banking capabilities in the world, for example. Having said that, Silicon Valley can still do it. OpenAI could potentially do it. You could have players like Stripe and so forth that become too big to ignore, and the traditional industry has to play with them in order to play in this next level of financial services infrastructure. So there are some drivers that I think are going to force adaptation. But I don't see a culture like you saw with the FCA, when you're talking about the regulation around fintech. The FCA is still doing that, by the way. They were the first to run tech sprints. They were the first to set up a regulatory sandbox. They've just set up a regulatory sandbox for AI and agentic AI right now. So
Also,
again, they're one of the first to do.
For blockchain as well, right?
Absolutely, yes. Right. And they haven't been fearful of that. The US sort of shut down blockchain and crypto for many years. We had the crypto winter in the US. Fortunately, with the Trump administration now, they've opened up that. But having said that, there's still, the reality is from a regulatory perspective, there's still a lot of resistance to anything that's going to shift, control away from, traditional incumbents in the market. And that's the biggest weakness that the US has. And it's not just in financial services. I think the bigger problem is healthcare right now. Healthcare, is massively inefficient in the United States. Administratively, the US, the US is always very critical of Canada's healthcare system and the UK's healthcare system. But let's be clear, the US healthcare system, administrative costs are 20 times in the United States what they are in Canada or the UK because of the privatization structure. The US pays twice per capita for healthcare costs what the rest of the OECD nations combined pay. So if you were trying to use AI to improve healthcare, the first thing you have to do is sort of dismantle the healthcare system, big pharma and big health in the US to be able to have that sort of advantage that AI is going to bring. That's unlikely to happen in the US market. I think it's more likely to happen in a country like South Korea, Saudi, or China than it is in the US, frankly.
I think that the administrative costs are large in any US industry, right? Like financial, healthcare, education, whatever you take, the administrative costs are amazing. And I totally agree. I think that's partially because, from one hand, the US market is extremely competitive. From another hand, it doesn't allow newcomers to compete in the same way with the incumbents, in so many different ways.
This is a really interesting issue because what we've seen with sort of the DeFi space, with the crypto space in general, is this push towards decentralization. But when we're looking at AI, decentralization is not actually advantageous because it's large data sets and sort of large ability to mobilize, that gives you significant advantages at scale. So if you're looking at something like medical diagnostics, decentralization is not a good idea, right? Centralized data sets and, better analysis of genome and things like that is going to be much more critical. So I think we're going to have to work out, and this is sort of really a question of where capitalism itself goes, is what's the best organizing principles for highly autonomous societies? And I have a sort of, not a very popular view, but I think the more automation that we put into modern economies in the 21st century, the less utility money provides. I think we're going to have much better organizing principles for the way we think about structuring society than capital. It's not a opinion that's necessarily popular, but I just see the utility of money declines the more automation you put in the system. So what is going to be the defining organizing principles for economies in the 2050s and 2060s? Think about how employment is going to change. Think about how longevity treatments are going to change. Think about how education is going to change with personalized tutors, tied to AI. We're really looking at an inflection point in sort of human society right now, where things are going to operate quite differently in the future. And that is going to require, some sort of fundamentally different new thinking, at the organizing principles level for human society.
I totally agree. I think that AI will shape the world at the end much stronger and in a bigger way than any of previous revolutions, including the industrial revolution and chip manufacturing and compute. I think it will just be something what we never ever experienced before. As we try to
it's not just
connect dots,
it's not just
there
AI.
is no way we can connect dots with like previous things happening.
You're right.
Like towards something new. There will be completely new thing, right? So
at the same time, I would say this: in the last 10,000 years, the two biggest impactors to the human species, if we look at it in the time frame of 10,000 years, the two biggest impactors to the human species will be the introduction of artificial intelligence, AGI and beyond, and climate change. Right? Now, I know that climate is still debated in some sectors, particularly in the United States, but it's very interesting. I was doing an interview last night for The Futurist, which is my futurist podcast, with Lisa Burdell, who's a New York-based futurist. And we noted that, and I know about 300 futurists. I don't know a single futurist that is a climate denier. Because when you're looking at forecasting and modeling for the future, you just have to take that into account. But longevity. Think about if you have the potential to live to 130, and you're born into the world today with the potential to live to 130 or 150. Well, do you finish schooling at 20, or do you stay at school till you're in your 30s? Culturally, you're not going to have a single career for life. You're going to be like it changes. Just that one thing on longevity changes.
What the school is. I would question like the very beginning. I mean, what is this like in a new
why do you need school?
Is it the school? Is it what like conventionally we think of a daycare like outside of like your?
It has to be something different, right? And that's the thing is all of these systems are going to be impacted by this. So we need sort of really fundamentally new philosophical thinking about what it means to be human. Like, let me give you an example. Let's say in 2040. So let's project forward in 2040 and I go to an event, right? I'm hanging out with some people and I meet someone at that event. It might be a dinner party or it might be a conference, right? And I say to that person, what do you do? Well, in today, when I ask you that question, you're talking about your value as an economic unit in society, right? You talk about, this is my job. This is what I do. This is how I create value in society. But in 2040, when they ask you what you do, your answer will have no economic component. What you do will not be related to how much money you earn, because the most successful economies will cater for your economic needs with autonomy. And what will be left is what you feel really passionate or, what you feel is meaningful, right? And that'll be your work, right? It won't be, it won't have an economic component like it does today.
I agree. Yeah. But I just have like a different perspective for the question. What will change? I mean, we can like speak of so many different ways that will change, right? So what do you think like top 3, top 5 things that will stay, right? What kind of values, businesses, if you will, professions will stay in the next 30 years? I mean, is there something what will not change? What will like continue to be?
So I think you still need governance, right? You still need governance, even though you're going to bring a lot of automation into that. In fact, I think that from a global perspective, there's going to be a lot more regulatory alignment between different governments, because you're going to need that, because it's inefficient to work country by country when you've got problems of scale like AGI and longevity and climate response. I think the largest single industry on the planet in the 2040s is going to be infrastructure and climate mitigation. I think that's going to be, for the next 60 years, we're going to be working on infrastructure, reimagining infrastructure for, what comes next. So I think that's going to be huge. But the big area is going to be human experience, right? I think, if you take away the meaningless sort of stuff, the repetitive sort of work that we do today and the robotic type of function, what's left is human experience and human differentiation. I think, in this transitional period, things like therapy and meditation and wellness and these sort of things will become massive industries. I think people will be moving around a lot more. I think immigration might sound strange to say this in the US today, but immigration is going to become highly competitive. Right? I think countries are going to be very aggressive about trying to acquire the right sort of immigrants, immigrants that can bring assets. Yeah, we already see that today. You're in Barcelona. Spain has the gold visa program. Portugal has the gold visa program. Dubai and Saudi have it. Thailand has it now. US is trying to do this $500,000 US or $5 million US, whatever it is, gold visa. So there's going to be a lot of competition because as birth rates decline, to keep consumption going, you're going to need immigration. So that's going to become highly competitive.
And it's not about, it's interesting point. It's like people to consume, not people to produce, right? Because now you need the person to produce. I mean, in a robotics economy, you don't need to have a person to produce.
Exactly.
Right? But
and 70% of GDP is consumption.
That's the problem.
Yeah. So this is another point. I saw a really good discussion with Yuval Noah Harari about this the other day. He said, everyone's so worried about immigrants coming in to take your jobs. What about digital immigrants? What about robots? If you don't like immigrants taking your jobs, you're not going to like robots taking.
You gave an example with ports, right? You can just go on a strike and protect yourself one way or another, right? With the law of the
you can, but we are going to see that. We're going to see a lot of forward adopting economies that really say, listen, here's our solution to technology and employment. We have a safety net, and we're going to provide this and this and this to people that are, like truck drivers who lose their job for autonomous vehicles. This is the approach we're going to have for that, right? And you're going to have other economies that say, oh, let's ban robot trucks so that our humans can keep driving. But that's not sustainable because over time, the more the more autonomy you put in an economy, the more you're going to supercharge the growth of that economy and sort of improve the operational efficiency of the economy as a whole. So keeping humans employed is not really going to be a defensible strategy, but in the US, you're going to have a situation where, let's say you get 40% youth unemployment because, all the entry-level jobs have been taken by automation. If you don't provide a universal basic income or some sort of social safety net, then you have societal collapse, you have revolution. And the reality is that that's much more likely in a country like the United States than it is, say, in China, because China will just figure out a way to solve that problem. But again, this is just another illustration because if we have UBI and we have all immigrants coming in to keep consuming, the problem is automation gives us this ability to sort of ramp up consumption, right, at a very cheap level, but that creates environmental problems for us down the line. So I go back to a report that was written in 1972 by the Club of Rome and MIT called The Limits to Growth Theory. I'm sure you're familiar with it. And in 2020, KPMG did another study on this, sponsored by Volkswagen. And, the limits to growth theory says that by 2040, that capitalism will collapse or the human species will be on the road to extinction because the level of automation that is possible in the 2030s and 2040s mean that if we don't become globally sustainable, we'll consume ourselves out of resources and extinct ourselves. So this is sort of the existential crisis that comes from our sort of GDP growth view. So ultimately, in the mid-2030s, with this high level of automation and this massive productivity gains we're getting, we are going to have to say GDP growth is no longer sustainable. It's not healthy for the planet. It's not healthy for societies. We need to move away from sort of consumption-based and growth economies to something that's more sustainable.
And this is going to be the end of capitalism. Because consumption is, in essence, like in the core of the model, right?
Yeah, but it doesn't mean when we say this in these sort of conversations, someone's going to come on and do comments about, oh, you're advocating communism and socialism. No, it's the fact is this is something net new. We're talking about a new economic system that goes beyond what we've modeled over the last 300 or 400 years. Is there something new? Because we've never had this technical capability before. We've never had AI in the mix. And so what comes after capitalism is not a system that we had 300 years ago. It's not Marxism or anything like that. It's something net new.
Yeah.
But at the heart of it is going to be, I think, philosophically about what is the purpose of an economy when it comes to the citizens of an economy. And this is where I see that future readiness is important, because in the 2030s and 2040s, with all of these massive technological gains, the economy has to shift to be about providing better quality of life to every individual in the economy. Otherwise, why are you doing all this stuff, right? If growth is no longer the objective, quality of life and longevity become sort of the core objective. And that means you have to eliminate poverty, you have to eliminate homelessness, you have to eliminate disease. They become the metrics of the measure of a successful economy rather than GDP growth. And so today, if I describe an economy that provides better healthcare and better education and longevity and all of those things, people are going to say, "Oh, you're talking about socialism." But no, let's just say
absolutely not.
This is just about making humanity the best we can be, right?
I think that these terms are kind of, they're not representing, socialism, communism, capitalism are not representing the state of societies anymore, right? It's
exactly.
like, certainly it's like all about like mindsets and ideas, right? I just read so much about like Roman Empire in last few years to understand why this was like fascinating empire. They had everything they needed to build up modern society, and they were very technologically advanced. They were also very socially advanced. They had the perfect kind of governance in order. They had a great culture. They had a great economic model. They had banks, credits, whatever you need to like build up steam engine, right? And then electricity, and they in 1,000 years they still didn't make it. And the reason for that is that they had like a different way of treating nature, right? They didn't think that everything is possible through experiments and testing and science, right? So they didn't respect
the
science
scientific
enough.
method. Yeah.
So the scientific method was elaborated in 17th century, and since then we made from like a lower base, we made much bigger progress than Roman Empire made in 1,000 years, right? In 300 years, we made more.
Yeah, so I think that's the point.
That's the thing. Now we have to change this mentality again. So, the mentality is different because now we have like different species evolving, like this AI kind of stuff, where we just need to like establish kind of different like way of thinking what it is, right? There's all this like artificial intelligence things, and how to cope with that. And I think that that's not about like being capitalist or being socialist. It's like about like completely new mindset to evolve. Yeah. And
so I think a good way to think about this is when we do have AGI, and AGI is only a few years away, if that, right? And we have AGI. One of the first things that's going to happen is AGI is going to disagree with us on policy positions. Let's take, for example, fossil fuels. AGI is going to say, it doesn't make any sense to still have, be burning coal and natural gas for electricity. Solar's massively cheaper than any of those fossil fuel sources, and it doesn't kill 10 million people a year with air pollution. So you need to get off fossil fuel systems, and here's the plan to do that. And you're going to have some economies like the US, that's going to say, whoa, hang on a second. We can't just do that very quickly, and so and same for, longevity. AI is going to say, well, you've got to change your behavior, and what you eat is going to change. And, the amount of time you spend doing physical activity is going to have to change. And someone's going to say, well, who's going to pay for that? There is, I think what you're talking about, and I've come to the same conclusion, I think, as you have by your language. It's just, this is largely a philosophical shift in humanity, right? It requires that philosophical agility. And there are going to be some economies and some people that are not going to be ready to make that philosophical shift. Let's say, for example, when we talk about AGI in terms of how it sort of impacts our world, and we start talking about incorporating advances in medical science and technological advances to improve our biology, or it maybe even incorporating Neuralinks or BCIs to sort of compete or sort of merge with AI in terms of our intellectual capability. There'll be some people that will say, that it's like abortion or transgenderism, that we can't, adulterate, the human genome with these changes. We need to remain as God created us. So, we could have a fork in the human species. We could have, Homo Deus, as Yuval Noah Harari calls them.
Yeah.
We could have AI and genetically enhanced individuals and natural humans, and we could sort of have a fork in the road there. But these are some of sort of the philosophical and ethical considerations that are coming right now that we're not really thinking about today. We're not really planning on how to deal with these, because humans aren't very good at that. We tend to be quite reactive rather than sort of planning. It wasn't always like that. Think about after the Renaissance, after the Dark Ages in Europe, the Renaissance, societies embarked on these 100-year projects, building these massive cathedrals and things like that, and pursued the arts, that like the times of Leonardo da Vinci and things like that, pursuing the art form and trying to really improve on that, and now understanding the scientific method, as you mentioned. These are all examples of humanity saying, what is it going to take to take us to the next level, to take the next step? And we're at that sort of point again of, what does it mean to be human? And that may be the greatest gift that AGI gives to us, is really helping us think about what is the purpose of the human species. It's not to accumulate assets anymore, right? That's the big change.
Yeah, and it will inevitably change fintech, what we started with. I think that we can continue on and on. The topic is so rich that we can do another 2 hours or whatever. But I think that we have to wrap up.
Sure.
And I really want to thank you, Brett, for your exciting vision. As always, anytime I speak to you, I find how much you actually change yourself. You are one of those people who never repeat itself. I've seen so many people, met so many people who are keep talking the same ideas, same principles, same things. They spoke about 10, 15 years ago. And speaking to you, it is always speaking to a new man, to a new person. So it's amazing, really. And I wanted to thank you. This was my friend.
That's a great observation, bro. I mean, we've known each other for a long time, so I appreciate that. And, I always love having conversations with you. We always have very interesting conversations. So.
Absolutely. Thank you so much. That was Brett King and Victor Orlovski. This podcast, Ventures from the Valley, was brought to you by R136 Ventures, and stay with us.
Ventures from the Valley is brought to you by R136 Ventures.
To find out more about R136 Ventures and how we scale mid to late stage startups by unlocking their true potential through investment,
visit r136.vc. We'll be back soon. In the meantime, make sure to click and subscribe so you don't miss any further episodes.
On behalf of our team here at R136 Ventures, thanks for listening.